Awesome. So hello, folks. I'm Shane, pronouns he, him. I work with Sandra with the Green Design Lab at Microsoft, but today I'm very excited to introduce Breene to all of you. Just some context, I was introduced to Breene, I would say a few months ago, and I was told he was one of the most thoughtful connectors in the climate space, and they definitely were completely right. Breene is a long-term climate activist, so my understanding is you've worked with elected leaders, local volunteers to
Yep.
pass climate policy. You're a talented writer. I would subscribe to his LinkedIn, anyone who doesn't already do that. And currently is working with Carbon Collective as the Vice President of Strategy
Thanks,
and
Claire.
Marketing.
It's a gift from my wife.
And yeah, awesome, sure. Yeah, that's a very high level intro. Breene, do you want to give a fun fact or share anything else with folks in terms of an introduction?
I mean, if you want to do a fun fact, I think the funnest fact I have is I was born in a hurricane. So in Hawaii in 1982, Hurricane Eva, that's when I decided to enter the world. So, embrace the chaos. Like that's the way I live. Yeah, I guess some things that I'd say in terms of introduction, like this is like really something that started with the work that my grandmother did. I was really influenced by her. She was just a tiny pillar of the community. 5'2", blonde hair. She used to wear these like bright blue blazers, the rhinestones on them, salmon colored lipstick. She was the mayor of her small town. She was on the LA City Planning Commission. She helped raise money for scientific research at USC's Wrigley Institute for Environmental Studies, which is amazing. It's on an island just off of LA, and it's incredible. And when she passed away, I took a step back and recognized that I was not having nearly the same contributions in my life that she had. And I recognized like how it built like a really rich life for her. She had like people that loved being around her. And I saw that as a way to like live a good life. So I took a step back and I was like, okay, let's get involved in climate. And I started volunteering. Shane like talked a little bit about like working with elected leaders. I worked with Citizens Climate Lobby. I did a lot of volunteer work. I was my congressional liaison and for my area. And that was how I got involved. Very quickly realized that what I was doing was not enough. Tried to get it to work more in my place of work. My place of work ended up being like a really fancy, wealth advisory firm. But they were like slow moving, like really great financial planning, but like their portfolios were heavily invested in fossil fuels, which bothered me quite a bit. So I ended up getting to meet Zach and James, that were the co-founders of Carbon Collective. And, I've been on this journey for a few years now. In terms of this talk today, this is going to be, so I know it says like employee action on this. It's going to be very heavy education based. And there's a reason for that. So I'm just going to use Microsoft here, but Microsoft has about $2 billion invested in fossil fuels through their 401k. That's a lot of money. The reason why they are investing so much in fossil fuels is because of the fiduciary responsible investment paradigm, right? Like I know that's like big words, but it's just like what has been defined as like what is the best practices for investing. And when you own the legal liability of providing those options, right? And so the reason why I wanted to be educational is because that understanding undergirds any action you can actually take at your company at the really high levels. So when you're going at a company as large as Microsoft, right? Like y'all are huge. So you're looking at probably treasurers, investment committees, like people with really deep, significant understandings, as well as probably you're going to have your general counsel involved that's going to be looking at this. Microsoft has faced past litigation, and so they're going to be extra conservative, right? And so I think something that's really helpful, at least what I found, is understanding the roadmap of where you're at, because getting $2 billion out of fossil fuels, and if they were into our portfolios, those would go into climate solutions. That's a $4 billion swing. That's a lot that's a lot that could happen. And so, but to do that, it's going to be, you're going to need to understand and empathize with where these people are, right? Like they're in a framework that has basically been defined by Vanguard, that, low fees, high diversification, basically passive investing. And they have faced like legal challenges. And so I think that is the framework that I would like to set for today before I go into the presentation, because everything I'm going to do is really going to come back to that point. So I'm going to share my screen and I'm going to get started. That's why the title of this is How to Be a Smart Investor Who Cares About Climate Change. And so the first thing that I want to talk about is really the two precepts that the two economic precepts that undergird the IPCC report. Basically, they have two things, and that's it. We need to stop investing in fossil fuels. We need to dramatically increase investments into climate solutions. Now, there's a handful of organizations that we rely on for research to do that. We are not climate scientists. We're not climate economists. But we see that we believe that they're very bright and understand this problem well. And so we look at it and they're looking at, we need to have about $5 trillion invested every year into climate solutions. And those are like very specifically, if you look at my wall, you got Project Drawdown. Project Drawdown, that's an old copy. It had 82 solutions then. They have 93 solutions now. And so it could be the famous ones, wind, solar, electric vehicles, batteries that you all know. But it's going to be ones that are lesser well known. Heat pumps are kind of becoming more popular, but it's going to be water irrigation efficiency, dynamic glass, waste to energy, more plant-based diets, and like the list goes on and on and on. So that's how they're defining it. Now, and we're using Vanguard very, very much on purpose because they are the largest influence on what is a fiduciary approach to investing. They've basically defined it over the last 40-ish or 50-ish years. It's passive investing. Unfortunately, that puts about depends on your portfolio, 8 to 10% of your portfolio in passive investments, in fossil fuels, but only like under 4% in fossil fuel or in climate solutions. And there's just not that many portfolios that, even if they say they're doing something climate related, this is just us giving an example of like how hard it is for people to get outside of that paradigm. They're still investing in fossil fuels, even if it's like Betterment's Climate Impact Fund, right? I mean, they hold the debt in the company that created the fire in the middle of the Gulf, right? Like that seems bad to me. And it's a tough business model and getting increasingly tough. So today I'm gonna walk you through a handful of things, why your investments matter, how to be a smart investor, just going back to that paradigm. Some of the myths that the people that, if you're going and talking to your head of benefits or the head of finance that's talking from the investment committee, like what their paradigm is going to understand and what they may have as a myth on sustainable investing. And then I'll give you some options on like how to build your own portfolio at a company as large as yours. You're always going to have like a brokerage link that you can access where you can go build your own portfolios and opt out, even if you don't have good options. And then I'll show you like the conclusions of how we do it at Carbon Collective. Big disclaimer, past performance, no guarantee of future returns. Like as much as anything, investing is a belief statement in the future. And so you don't know how things are going to perform like day to day. We're pretty convinced that the insights we have are going to be good, but a lot of investors have had that. So I just want to give you that caveat. Shane, I'm seeing notes in the chat pop up, and Sandra, can I just flag you guys to just say, there's a really important question, would you just butt in? If not, I'll come back to them at the end. Is that okay?
Yep.
That's perfect.
Okay, so I'm going to define terms real quick. ESG versus sustainable investing versus impact investing. ESG investing, which is the term that is probably most popular, is a term that is a risk framework that defines environmental, social, and governance. Governance is like looking at, we have a board of advisors at our company, and like, like Satya Nadella can't do anything he wants at Microsoft. He has to go to the board and get things approved with their shareholder actions. Like that is like what's considered like a governance structure. So that's governance. And so where it came from is if you could minimize these risks, you could actually get outperformance. And so this is an old framework from hedge funds. Sustainable investing then is different than ESG investing. So our perspective, and this is our definition, right? Because there's multiple definitions. And the reason why we try to make this clear is because there are a lot of definitions we've seen of sustainable investing are more just ESG investing. So our definition of sustainable investing is the stock market cannot accurately price in long-term environmental trends like climate change. So sustainable investing is built around those externalities, right? Which is like externalities, things that are not priced into the market, but are happening and have a price. And then impact investing, my dog disagrees with me, she just barked at me. How is moving my money making a real difference? So impact investing, it's like why we're on this call, like how can we drive climate action, right? And so this is about how your money is making a difference, what it's investing in, how is it decarbonizing might be a way you would be thinking about it. So those are the three terms. At Carbon Collective, we tend to find ourselves in the second two. We don't closely align ourselves with ESG. Just the data that we use, the way we build portfolios is different than ESG investing. There's been a lot of anti-ESG noise lately, largely funded by fossil fuel companies. And we just kind of feel like we're separate from it. So I want to be clear on a lot of that. Why investing matters. Number one with investing is voting. This is a really good story about how a small hedge fund, it's called Engine Number One, they got 3 board of directors on Exxon's board. Now, we don't believe that that approach is the best way to use shareholder advocacy, because since then, Exxon has actually walked back their climate commitments, but it is a really powerful way. Number 2, cost of capital. You really saw this with Tesla. When they were just screaming, getting big, it was really easy for them to get cheap loans and cheap access to capital so that they could expand their charger network at a time. Now their chargers all over the place and it's dominant. Like that is a way in which their stock price can really help. This is a good example at Plug Power. Now the third one is narrative. And this one is really the core of why like the fossil fuel companies are trying to find this anti-ESG movement, is because they're worried that they're going to face a similar path as coal, which is pretty likely. So coal from 2010 to 2021 dropped 99%. That's a bad investment. If you would have invested $1,000 in the coal index, you would have 10 at the end of those 10 years, right? And it's not because we don't use coal anymore. It's because coal doesn't have a competitive future. And when it doesn't have a competitive future, it goes by the wayside. People don't want to invest in it. And it becomes this thing that starts to stagnate in private markets, gets smaller and smaller until it goes away. And so that's what we're seeing. So those are a couple things that we want to share. Why passive investing is increasingly unable to price in the long-term risks. So this is us sitting apart from the anti-ESG movement, sitting somewhat separate from the ESG movement, and looking at like how to be a really smart investor. So passive investing is the paradigm. It is what exists in your portfolio. It's why you have so much invested in fossil fuels. And it has been proven time and again that it will outperform active managers. Now, active managers are often trying to pick the right stock. They usually have higher fees, which eats into the returns. And so Vanguard has very systematically published research report after research report after research report saying that the system is more valuable than the individual. But what happens when the system is broken? And so what happens is in this situation is we have gone from a scenario in which it used to be that the long-term investors would be really active. They'd be betting on long-term secular trends that they need to invest in. This is like pension funds. This is endowments at schools, retirement plan advisors. Like they would be looking at 10, 20, 30 years. Like a bunch of people on this call are probably not going to retire for 20 years, 30 years. So you're looking at a very long time horizon. But what's happened is these long-term investors that have a fiduciary responsibility are abdicating their fiduciary responsibility. And what they're saying is like, hey, we think the system is great. We are not going to vote. We're just going to put it in the markets. Now, 50% of all ETFs are passive investing ETFs, right? And so the price signals, the people who are buying and selling, paying attention to trends are like, you know, the meme stock people or day traders or, you know, hedge funds or like high frequency traders. And so what it means is that the stock market like is increasingly unable to price in things like climate risk. A very good example, someone that I like to look at this a lot is Jeff Gitterman. He's someone worth following. But like he talks about how the insurers are no longer insuring in California. That's going to drive up the price of home ownership. That's going to eat away into different parts of the economy, right? And so like if traditional investing is not able to price this in, or biodiversity loss or rising seas also affects insurance, or wildfires, like, you know, so a lot of this starts insurance based. And so that's the risk, but they're also not able to capture the opportunities. We can't capture in the rise of electric cars. Electric cars are poised to have about 20% of global sales in 2023. That's the projection. Rise of renewables, exponentially expanding. Rise of batteries, decline in oil demand. I don't know about you guys, but like when Russia invaded Ukraine and caused that energy spike, and we saw like very, very expensive gas prices, we had a lot more people going, you know what, I'm going to buy an electric car, right? Like that just happened. I lived it. I was very fortunate. I bought an electric car before then. Like we built our lives around driving the electric car because then we didn't have to go to the gas station, right? So this is what we're saying. Like the current paradigm is not poised to actually invest in a fiduciary responsible way for you. So if you go talk to your head of benefits, if you go talk to your investment committee, you're saying like under these timelines, fossil fuels is not likely to perform, and that you need to have options. I don't think you should have like a total replacement. I think there's some people that are going to want to have the traditional thing and keeping that in there. And so it's a way to look at having a much lower fiduciary liability. Now we're looking at why it's going to outperform. I want to get in the nitty gritty. So fossil fuels have full stop have not been necessary for long-term historical performance. Now you can trust us, or we can look at someone that has $100 billion in assets under management. His name's Jerry Grantham. He did the research. Basically, and this isn't like a more climate stable timeline, you know, just to start out with, but energy was responsible for it's called basis points. It's 0.05% of outperformance over like almost 100 years, not quite 100 years, 92 years. So in this timeline, he's basically showing like that's not what's valuable. But since then, now this is like not quite up to date. This is like about 6 weeks old. What we're seeing is it's really starting to underperform. The blue is the standard portfolios or the S&P 500, and the green is the fossil fuel index. And you're seeing like radical underperformance here. It came back, but it's already starting to go back down. This is like the 2021 to end of 2022. That was like a very good year. And that was when like inflation was high, that it affects commodity prices like oil. And that's when it came back, but it's already going back down. So it hasn't really been a good indicator of performance. And there's been other places that have shown that, you know, the Colorado pension fund over the last 10 years, they've had a $2 billion performance drag because they've invested in fossil fuels. And so our belief is that a place like Microsoft or a place like Google is facing increased fiduciary liability because their portfolios have underperformed over the last 10 years because of their exposure to fossil fuels. But right now, like that's a past look. But going forward, it's like fossil fuels have never faced competition like this. Like, look at all the EVs on the market. Look at solar. Like, it used to be like, I mean, I've wanted to have an electric car for a long time because I've been involved in climate, but like I never had one for a long time because there were these stupid junky cars. You could drive them 30 miles. Like I wasn't going to drive that. Like I couldn't. And so this is an example of the past paradigm. This is horse and buggy to cars, right? This is how fast it happens. You know, in 1900, you have one car in New York. In 1913, same place, you have one horse and buggy. I actually don't even see it. Zach tells me it's there, but I actually can't quite see it. This is because better tech will exponentially grow. And so what we're seeing is in the virtuous cycle, this is with renewables, and it starts with government support, more investment, but it starts to go higher margins, higher revenues, then lower costs, more public acceptance, better capability. And this is where we're at. Economies of scale and variety. Like this is happening. You can buy cars all over the place. You know, you can buy different types. You know, these are electric vehicles. And then if you look at the death spiral, it's like reverse economies of scale. People don't talk about how fracking was a $300 billion boondoggle for the fossil fuel companies. It was incredibly expensive. It was not profitable. There's less public acceptance. You and I on this call, we don't really want to be exposed to fossil fuels. Microsoft has like a whole like carbon pricing. I read an article on that, which I thought was really cool. Higher costs. You go to the gas station, it's more expensive to fill up, you know, than to charge your car. Lower revenues. You were not like this one. We got a bump in revenues in the fossil fuel industry, like in the last year, and the margins, but they are starting to see less investment, less government support. There's going to be carbon border tariffs in Europe, right? Which is mean they're going to tax things and from places that don't have a carbon tax. And when you look at where their markets are, because when you're investing, you're basically saying this is going to continue to grow. You're looking at about 60% is in transportation and electricity. And so like looking at the transportation area, electric cars are better, cost the same, and will soon reach cost parity. Faster, more powerful, less maintenance. I have an electric car. I haven't taken it in for maintenance in 4 years. I used to dread that every 6 month, like $600 or $1,000 charge I was going to get. Do you know how much I hated that? I hated that. You know what else? No one talks about, like, this is me personally, I just don't like gas stations. They're creepy, you know? And so it's like, I get to charge at home now. It's so much more convenient. They're safer. They have fewer moving parts. And so this is what we're talking about with electric cars. Comparable lifetime costs. This is not at the dealership yet. It's more upfront, but it's lower fuel costs, lower maintenance. And soon, like, it's going to be cheaper to buy. And they're already expecting it by 2027. And this is what I was talking about. Like EV sales, they are soaring all over the place. On the electricity generation side, this is like your utilities, your home generation, 20% of fossil fuel use, and 61% of electricity comes from fossil fuels. But renewables now have the economic tailwinds. You know, like on a personal level, again, I try to use these personal examples to make it more tangible, like these very large trends that are sometimes hard to see. I went solar on my house. I save $150 a month. That's what we mean when we say that solar has the economic tailwinds. This is happening all over the world. There's going to be, and this is with, like, at the same time, large governmental support for fossil fuels still. It's now beating them, even though they're like the fossil fuels are still getting support. And it's just growing exponentially, wind and solar. And then you factor in a warmer planet is bad for business. We're already starting to see this, unfortunately. It's like less predictable crop yields. I mean, this summer has been insanely hot. I mean, record setting hot, unfortunately, many days in a row. You're seeing damage to critical infrastructure. This is where we're going to get rising insurance costs. Like, unfortunately, in California, like where I live, I have fewer insurers, which makes a less predictable real estate market. You're going to see greater political instability, more lawsuits. And so when the pain is bad enough, legislation will come. So we've already seen the Inflation Reduction Act, but we're seeing carbon border adjustments coming in Europe. It may be ending fossil fuel subsidies. Like, that's a real thing that could happen that would eat into their bottom line. Lawsuits are happening. You're starting to see a bunch of people that are starting to divest because they no longer believe that you can work with oil companies in good faith. So in summary, fossil fuels outcompeting on transportation, outcompeting on electricity, and they're facing significant legislative risk. Over your lifetime, if you're a fiduciary, if you're thinking about, you know, hey, I want to worry about Shane's retirement, right? Like, does it seem likely when he retires in 2050 that fossil fuels will play like an important role in his portfolio? It seems very unlikely. So I want to get into tools for building your own portfolio. This is also very important, right? Because, and this chart specifically, because the people at your companies are going to be really considering the cost. It's been very clearly demonstrated that the cost of things eats into the returns. So what you have is, we're showing impact on the y-axis, and we're showing fees on the x-axis. And what you're seeing is like, it still is really hard to buy cheap, high impact options, right? And so that's where they get into this pickle. So in green funds, and we're going to show you this. This is like a scenario where, well, let's say there's a situation at your company where you have a big ERG and you want to have a bunch of people who leave from and go open a brokerage account. They can actually get their money and manage it on their own. And Microsoft is like, good. You know, maybe they see a lot of people doing that. Like, I think if you had a group of people doing that, that would be significantly higher. Like from the DOL, this is also something to look at, which is like participation rates. So it's like, you're starting to see people behave differently. It's going to start to trigger people going like, hey, what's going on? Green funds, you have Invesco. They have the solar ETF. We try to highlight diversification a lot because we really want you all to be like, understand smart investors. This is like, and so when you look at total percent of the market, it's hard to put a large percentage of your investments into something like this. You know, you can see they're all under 1%. Like another green fund, we actually have our own. We don't like to highlight our own because we try to make this educational, but if you want to ask questions about it later, we can. Climate funds. So this is Etho Capital. Like we know the folks there. You can see this one is like, you know, a larger percentage of the market. Kind of an interesting theory of change too. They are in like the apex of ESG investing to us, where they're going for, and forgive me if I'm wrong on this, but when I looked at this, like the lowest emitting 20% of every sector. So we'll still have fossil fuels in it, but it'll be like the most effective or like lowest emitters of fossil fuels. It's a little on the expensive side. It's probably not something that you would have for your whole portfolio. Then you have Grantham. He has a large cap fossil fuel free fund. It's also a little bit bigger than the last group. Probably not something you'd put your entire fund in. And then you have Aspiration. To be honest, like that, we just put it on there because people ask us questions. It's not a very good one. It's both expensive with like not a clear theory of investment change, and it's like it's also small. So in terms of ESG and voting funds, most places will, you're starting to see more places. I don't know what's like in the fund list of like all climate tech companies. We're starting to see some places will put like one small thing, Vanguard ESGV, or they call it like FTSE, it's the FTSE. They might put in, there's the State Street Spider, and then engine number one, this is the one that got the 3 board advisors on Exxon. They hold the broad market. It's really hard to say if they're more impactful. There's actually a really interesting Freakonomics episode that highlighted them. I disagree with it, but I just wanted to make sure you guys have like access to like the information that you know, so you can make good decisions. I'll probably go through this a little bit faster just because this part is not as relevant, but it kind of looks at what a whole portfolio might look like when you're looking at like a climate impact portfolio. A good tool to use if you're going out on your own, as you so's fossilfreefunds.org. You can get all the ratings. It shows retirement accounts. It's a great tool. So I just want to make sure you guys are aware of it. Emerging market bonds. This is when you get into like when we get into this, we tend not to do a lot of emerging market bonds just because so many are from sovereign nations that rely on fossil fuels, right? I mean, looking at Qatar, Turkey, Saudi Arabia, Russia. I mean, we all know Russia, unfortunately, too much lately. So what happens is even in these portfolios, you're still getting I mean, it's better than that 8% I was showing before, but you're still getting almost 5% in fossil fuels. You're still getting a very heavy amount of CO2 emissions per $1 million invested. So that's like what we're seeing happen. So maybe some approaches, a one fund, less bad portfolio. You could also do Sphere. They have a portfolio that's similar to this and it also votes. It's SPFFX is the ticker. A two fund might be ESGV and like the iClean, and this would just be on the equity side. Three funds, you might do something like this. You could build Etho, like I was telling you about their theory of change. You have another clean energy ETF, and you have like a large cap one. So it would still be a little bit narrow on a portfolio. To be honest, like I probably wouldn't do this, but like we wanted to share what some people might be thinking about. Now I wanted to share our conclusions, right? And this is important because what I just walk you through are probably the things that, like, if you go to investment committee, that's what they're going to be thinking about, right? What are my options out there? Now, the problem is you saw they're either too narrow or too expensive, right? Or they have too much in fossil fuels. So a lot of times, like, this is where my empathy for people in these situations comes from. It's coming from this place of like, they're getting people like you all who are like, hey, can we get fossil fuel free options? And the reality is like, there aren't any, right? And they like, this just sucks. The truth is, and this is not something that a lot of people do, but they build portfolios on your 401k. This is possible. This is what is the role of what's usually called a 338 investment manager. Like, they build these portfolios. They can build, like, this is what we do. We build target date portfolios. So in the absence of single fund options, we create them for people. And this is how we're able to do that. So I just wanted to let you know of like the deep pain that the people in HR and on the investment committee are facing when you're challenging them. So you can help guide them. I really believe understanding people's plights is crucial to solving problems. I mean, there's a world in which like yelling at them a lot like can help too, I guess. But like, I've never had someone yell at me and then I was like, you know what? Great point. Thank you so much for yelling at me. You're right. I'm a moron. I'm going to change. Like, I've never had that response. I would like to think I'm enlightened enough to have that response. But I continue to disappoint myself. I'm like, So this is what it looks like in a portfolio approach. Our theory of change is really around divest from industries who can't exist in a zero carbon world, reinvest in companies that are building solutions to climate change, and pressuring the rest to become, frankly, more like Microsoft, right? You all, and what you do is, and there's like actually a lot of tech firms are very good at this. It's like instituting internal carbon pricing, trying to understand how to lower your footprint, like sourcing renewable energy, like that is amazing. Like, and it's better for your business. Like, more companies need to understand that playbook. So that's what we mean when we pressure the rest. So when we look at it, we're trying to keep our fund fees really low, right? We have an approach that we're building portfolios, not just single funds. We're building portfolios. Our way of doing this is a little more complex than everything I showed you. We do sector ETFs. Those means, so it's like there's 11 sectors in the economy. And so like we'll buy like the regional banking ETF and it's only 8 basis points, right? It's only 0.08% in fees. So we're able to like wiggle our way around the pricing, but still get broad access to the markets. So we end up having something that's really diverse. And the cool thing, for people on this call is like we end up having a carbon footprint that is about, it's about 80% lower, right? We're looking at 10 tons of CO2 emissions per $1 million invested. Now, we are not trying to get to zero because the zero doesn't exist, but also we are facing, the fact that we have to build our way out of solving climate change. And so some places that need to build solar panels or wind, they're going to be fossil fuel dependent on their scope 1 and 2 emissions, even though their scope 3 is going to be like really negative. So that's something we want to talk about. And then what we end up doing, so like for somebody who's, I'm going to use Shane. I know Shane, so it's like, let's say Shane is looking at retiring in 2050, right? He's like, I want to have a great career at Microsoft. An 80-20 portfolio, which is basically 80% stocks, 20% bonds, might be a good one. And we might put like a little less than 20% into climate solutions, keeping access on that middle group to the broad markets. And this is like the broad markets would be Microsoft, Costco, Amazon, you know, like NVIDIA, like all these companies doing these things. We do, on our personal side, we do offer climate only portfolios. This is just our ETF with a green bond fund. I would say in a retirement account, this is not what we recommend, but it is possible. It's a very simple approach, just buying our ETF and then a green bond. It's usually BlackRock's green bond fund, and that's a way to do it. This is us saying we offer green 401ks for mission-driven businesses. We've been helping a lot of companies. I've been talking to very large companies, not unlike yourself. There's a lot of interest for this, but again, wrapped under this problem of how do we address it in a fiduciary responsible way? And that's hard for these big companies to be thinking about. You know, and so I think that's a way where you basically have, from an employee standpoint, largely two options that you have in front of you, which is to like really engage these groups and say like, hey, we know this is hard, but there's options on these plans where you don't have to create single fund options. You can create defaults on portfolios. That is possible, right? And at the same time, it's like, if you don't like this, you can then know, look, I'm going to opt out into the brokerage channel. That is much hard. Like, you're then responsible for your own decisions. That is harder. So I wanted to give you all that. So I don't know your situations too, so I don't know what like the best portfolios are for you, but we wanted to give you some things that in general could be helpful in the case that you decide to want to do this. Okay, that is the end of my presentation. It went a little bit longer. I think we got a little start, so it was like 35 minutes. The thing I want to say, like most clearly, like email me, reach out to me on LinkedIn. I would love to be a resource. I'm very passionate about this. Like, I know people are like, 401ks, like that is boring. And I'm like, that's the most exciting thing in the world. So I'm very excited about it. I feel honored I get to be able to do it. I know it's painful for people. I love being able to like solve that pain. There's always this aha moment when they get there. So whatever you need from me, email, like LinkedIn, those are the best ways to get a hold of me. Yeah, let's jump into questions now.
Amazing. Thank you so much, Breene. I'm going to stop the recording and then we'll go into the community discussion.